things the market has taken for granted is that, listen, we've seen disinflation 2023 year to date, so we're going to go on pause, and then we're going to start cutting sometime pretty early next year. And then we'll be out of the woods here, and the inflation story will be in the rearview mirror. I think that the print yesterday is caution to that wind, and any kind of surprise that takes away from that narrative will be a knock on the market. And I think we should fully expect that, because what the Fed cannot risk after being late to the game in raising rates is a double bump in inflation, and there's a real risk of that with energy prices where they are.
I want to get into what you're seeing behind the scenes in private markets, because we know that it's been dominoes when it comes to the rate hikes for various different parts of the market. And, traditionally, I remember years ago, private equity would say, oh, look, we're not influenced by interest rates, so we're long-term investors. It doesn't really touch the sides. But I think there was a reset when we had zero interest rate policy for so long. A lot of people took on more risk, the market conditions changed, and then suddenly the door was slammed shut when we had the rapid rate hike story, which impacted a lot of people. What are you seeing out there in private markets now? Yeah,
I think there's private equity and there's private credit, which is a huge new influence on the market. So I want to touch on both. But in private equity, you're absolutely right. Private equity went on pause. There's no doubt about it, from this, last quarter of 22 through to summer of this year. Now, the thing with private equity is that they do need debt to finance their acquisitions, and the debt lenders, the bank lenders in particular, shut shop, saying, listen, we don't know where terminal rate is, and so therefore we don't know how to price the debt. But also beyond that, private equity wanted to take stock of their existing portfolio. The thing with private equity and private credit is that it runs on a clock. It's the funds have 10-year lives. It's 4 to 5 years to make investments, 4 to 5 years to harvest them or exit them. So while they can go on pause, they cannot break the system here, otherwise that impacts their own fees and their own ability to raise capital. The other thing that should not go unnoticed is the rise of private credit. You see that in Blackstone's numbers, you see that in the numbers of many others, which is a non-bank lending market, which has really grown in the last 5 years and has stepped into that void.
Sunaina, good morning to you then. I want to touch just even on the bond yields themselves. Have those peaked at these levels? Or was the peak, the one we kind of saw towards the end of last month in particular? Yeah. But we say that in the context of still not being very sure whether, even the ECB, whether they're done for that matter, right? We don't know if they'll... So would rates have peaked at the current rate?
Hard to tell all of a sudden, isn't it, over the last week?
Yeah.
If we had been having this discussion in the last week of August, we'd have said we're closer to terminal rate than we ever have been before. Today, with all of these numbers and also the OPEC plus signal that energy prices are going to be at or close to $100 a barrel sustainably, it's a different picture. When you break out the components of inflation, goods and services, we all talk about goods inflation is coming down, but maybe not anymore with the input costs that, as you mentioned very rightfully so about half an hour ago, input costs being energy on transportation is an underlying component of so many goods. One has to question that, and we all agree, I think, that services inflation takes a very, very long time in a very broken economy to go the other way. How do you reduce somebody's salary?
Yeah. So does that mean if we're saying that the Fed doesn't hike then next week, but they hike in November, would you not then need 2 hikes actually, because your work wouldn't be done surely with just the 1 hike, or is it just a case of the pass-through still from all these hikes that have been in place will still play into the market at that stage?
You potentially might need 2 hikes, but here's something else. The market is actually pricing in cuts. So if they deliver, the Table Mountain strategy of higher for longer, if you will, in that case, that is like a hike to the market, right? Because the market's pricing a cut, and that's going to be a negative surprise to the markets too.
So what do we do when it comes to allocating around equities? There's been this big debate around growth and value. Some have been trying to dip back into value, even though growth has been all dominant in recent years. What do you do in terms of defensive positioning around this market now, and also adding a little bit of risk if you think that things are not as bad as they could be?
Yes, I think what's interesting is that one of the things that's fueled the market rally is cash coming out of money market accounts and going into risk assets. And that's really been a result. If someone had told us in January that the S&P and NASDAQ would be where it is today, I think we would have taken it and run, right? So I think that now we're starting to swing the other way. So I would say go back into the short-term bond instruments. They're still yielding nice numbers, 4.5%, 5% cash. Take that. It's a safe harbor place to be.
So don't be greedy.
Don't be greedy. Go to BDCs, go to investment-grade credit. That's 6 to 8%. It's a good place to be. It's very risky playing equities today, whether defensive or growth, because there's so much uncertainty on both sides of the mean.
Yeah.